Welcome to another edition of TLA. In this session, we'll dive into an advanced guide on smart money concepts, a trading framework that aligns with the market driving forces capable of influencing price movement. If you're interested in mastering advanced trading concepts, strategies, entry triggers, and maintaining discipline with a trading plan, be sure to subscribe to our channel and explore high-level trading content. Catch you right after the intro. Based on the comments, we received many requests to create a video focused on smart money trading strategies. Since we rely on your feedback to choose upcoming topics, drop a comment below and let us know what you'd like us to cover next. To apply these strategies effectively, it's essential to grasp smart money trading concepts first, as they form the core of this trading system and proper execution on the chart determines success. Let's begin with supply and demand. A supply or demand zone is an area where price moves away aggressively, causing inefficiency and either a structure break or a shift in character. When spotting supply and demand zones for trading, consider three key factors. Did it cause inefficiency? Did it result in a structure break or character shift? Did it build liquidity leading into the zone? So, what exactly is inefficiency? Inefficiency appears when there are gaps between candles, and when this happens, price often returns to that region to fill the void. What do we mean by break of structure and change of character? A break of structure happens during a trend continuation. Each time price breaks a structure level along the same trend direction, it confirms the trend is ongoing. In contrast, when price breaks a structure level in the opposite direction, that's called a change of character, indicating a potential trend reversal. Change of character supply and demand zones work best when they break through multiple supply and demand areas. This type of change of character appears after a mitigation on the higher time frame. Price drives through the zones impulsively using a series of large candles. What exactly is liquidity? When smart money aims to purchase a large volume of currency pairs, they require sellers in the market. The setup that allows them to do this is referred to as liquidity. Picture an uptrend. If institutions want to buy this currency, they'll obviously need a pool of sellers. But in an uptrend, most participants are buyers. Now, suppose price forms a support level before hitting the demand zone. This support becomes a key zone where support and resistance trade is set by entries. And what sits below those buys? Stop losses, which are sell orders. That's when smart money steps in, grabs the sells, and enters their buy positions. Change of character supply and demand zones show higher accuracy when price breaks through two or more of these zones. A change of character typically occurs after a mitigation event on the higher time frame. Price surges through those levels aggressively using several strong candles. So, what is liquidity? When smart money needs to purchase a large volume of currency pairs, they require sellers to be active in the market. The circumstances that allow these positions to be filled are known as liquidity. Now, picture an upward trend. If major institutions are planning to buy, they logically need a significant number of sellers. But in an uptrend, the majority of traders are buyers. Suppose that price creates a support level just before touching the demand zone. That support becomes attractive for support and resistance traders to place buy entries. And the stop losses for those entries? They're sell orders. This is where smart money steps in, collects the sell side liquidity, and enters their buy positions. Let's cover some key aspects of liquidity. Liquidity zones serve as extra confirmation for a high probability trade when they form either above or below a major trading zone. While there are various types of liquidity, our primary focus is on equal highs and equal lows. Stop losses represent liquidity. Wherever stops are clustered, liquidity can be found. Up next, we're covering order blocks. Order blocks are refined supply and demand areas. The most recent candle responsible for creating the inefficiency is marked as the order block zone, whether it's bullish or bearish. But we have three rules for a valid order block. First, it must have inefficiency. Second, it should lead to a break of structure or a change of character. Third, it must be unmitigated. Unmitigated means that it has not been tested by the price yet. Since order blocks are one-time use, we don't consider trading mitigated order blocks. Here is an important point in two conditions. Here's a key point. There are two situations where wicks are considered order blocks. First, when the wick of the order block candle is larger than its body. Second, when the wick of the next candle reaches down to collect the pending orders. Now let's move on to market structure. supply or demand, who's in control? Imagine you're looking at a 1-hour structure and price arrives at a demand zone. It might seem reasonable to search for long setups. But what if that price action is actually coming down from an unmitigated 4-hour supply zone? That means you should focus on trading with the dominant market force. Say you're waiting for a demand setup to go long, but the price has dropped from an untouched supply zone. In that scenario, supply is controlling the market, and entering off demand requires solid confirmation. Always identify the origin of the price move. There are two scenarios where a risk entry becomes valid. First, when the price breaks through a supply level, indicating a bullish bias on the higher time frame. Second, when the structure is broken but price hasn't yet tapped into the unmitigated supply zone. Let's go through an example to determine which side has control. Take this case. Imagine we're analyzing a 4-hour structure, and it's clear the market is in a downtrend, meaning supply is dominant. Even though there's a short-term uptrend, the bias stays bearish as long as price remains below the 4-hour supply zone. However, if that major 4-hour supply zone is broken, it signals that demand has taken control. From there, as long as price holds above the main demand zones, the bias turns bullish. But if the demand zone breaks to the downside, it confirms the uptrend is over and supply has regained control. Now that you've grasped the foundational concepts of the smart money trading system, it's time to break down 3 of the most effective entry strategies. But before we dive into that, if you're finding value in this video so far, make sure to hit the like button. It really helps our team keep creating more content like this. Also, drop your thoughts or questions in the comments below, and we'll make sure to respond to each one. Next up is the trading plan for the upcoming strategies. We suggest focusing on just one currency pair and trading in a single session, either London or New York, as they offer the best setups. You should completely master your selected pair by rigorously backtesting it. Go back a few months on the charts and analyze every session of your chosen time frame. For example, we personally stick to trading EUR/USD during the New York Open, for about 3 hours daily. The reason? We got into Forex to gain both financial and time freedom, not to sit at the charts for 8 to 10 hours straight. Keep in mind, each session provides more than enough trading opportunities every day. Now, let's move forward with the trading plan. The Smart Money trading plan is built on 2 essential steps. First, assess the market structure on higher time frames to determine the overall direction, identifying which side is in control, along with key supply and demand zones or relevant order blocks. Second, switch to lower time frames to look for precise trade setups using 3 types of entry patterns: supply or demand flip, change of character, and continuation. When assessing market structure on higher time frames, as previously explained, we focus on 2 elements: the overall market direction, identifying who's currently in control, and locating prime supply and demand zones or order blocks. Take this EUR/USD example on the 4-hour chart. Beginning from the left, we observe a break of structure alongside inefficiency, giving us an order block. Price then drives upward, creating inefficiency again. However, since it fails to break the previous structure, this area qualifies as a demand zone. Later, the price breaks below that demand zone, confirming that supply has regained control. Another inefficiency appears, along with a structure break, allowing us to mark a new order block. This zone would present a solid short entry, with the next unmitigated order block serving as our target. Switching to the 1-hour chart of the same pair reveals more refined details. This is the point where supply asserted dominance on the higher time frame. At this point, both higher and lower time frames signal a bearish outlook. Right here, we identify a clean order block pattern, which would have offered a solid short entry. The take profit level in this scenario would be set at the unmitigated 4-hour order block. This serves purely as an illustration of how we assess market behavior using the higher time frame. Now, let's shift focus to our entry techniques. In this second phase, we monitor the lower time frames to enter trades using one of 3 specific entry models. The initial setup is known as the supply and demand flip. In this scenario, the price forms a new high and then revisits the most recent demand zone, reacting with a push upward. However, it fails to form a fresh higher high. Instead, it breaks below the previous demand zone with strong momentum, establishing a new supply zone. The price then returns to this supply level, where we place our limit entry and activate our trade. Let's walk through a real-time chart scenario. In this case, the price breaks a structural level while leaving inefficiency behind, forming a strong supply zone at the extreme. After interacting with this supply area, the price is unable to push to a fresh higher high. Instead, it pierces back through the supply zone with an inefficient move, turning this specific candle into an ideal order block, presenting a solid short trade setup. Here's how we execute the trade. We place a sell limit order just a spread size below the identified order block zone. Our stop loss is positioned a few pips above the high of the order block. For the take profit, we aim for the next significant demand zone visible on the higher time frame. Keep in mind, this pattern is most effective when price aggressively rejects demand or supply zones and swiftly breaks through the last demand zone, leaving clear inefficiency behind. Let's move on to the next setup. This one is called the change of character pattern. It forms after price mitigates a higher time frame supply or demand zone, which means we only trade this setup when the market aligns with our higher time frame direction. In this case, our higher time frame bias is bearish. After price taps into the supply zone, we see a short-term shift in trend direction, also known as a change of character. This shift occurs with inefficiency, leaving behind a clean supply zone. When price returns to this level, we look to execute short entries, taking advantage of the newly formed imbalance and structure shift. Let's break down a live chart example using the EUR 15 United States dollars minute time frame. We're working with an overall bullish bias, supported by a clean, unmitigated 4-hour order block. As price approaches this zone, it's uncertain whether it will trigger a move to the upside, because despite the higher time frame being bullish, the short-term trend is still bearish. Once price taps into the demand zone, the market shows a change of character, a structural shift marked by an impulsive, inefficient move, which leaves behind a well-defined 15-minute order block. This signals that the short-term downtrend may be coming to an end, and momentum could shift back in favor of the bulls. Here's the setup. We place a buy order a spread size above the 15-minute order block. Stop loss goes just below the swing low. Pro tip: change of character trades are most effective when the price breaks through two or more supply or demand zones, especially after a higher time frame mitigation, and typically do so with strong, impulsive candles. Let's move on to the next setup, the continuation pattern. This strategy is used only in clearly trending markets. Every time the market forms a valid order block, following all the criteria we've covered, it presents a potential trade setup. But here's the key: you should only enter if both your higher time frame and lower time frame align in the same direction. Important reminder: the market will often present multiple entry signals when trading the continuation pattern. So, while it's a powerful strategy, proper risk management is crucial to avoid overexposure. Let me show you what I mean with a real chart example. Starting from the left, here we had a winning trade, then a losing trade, followed by another losing trade, and finally another winning trade, and so on. The key takeaway: patience and solid risk management are essential for success with this trading pattern. Now, for the final example, I want to demonstrate what a true multi-time frame analysis looks like, combining all the concepts we've covered so far. Starting on the 4-hour time frame, we clearly see that price broke the last demand zone to the downside with inefficiency. This candle that created the inefficiency becomes our order block, a perfect zone to watch for short opportunities. So, overall, the 4-hour chart shows a bearish bias. Since price has reached our area of interest, we zoom into the 1-hour time frame to check the current momentum. Here, the market is in an uptrend, so we need clear reversal signals before placing any trades. We also spot some equal highs, which create an ideal liquidity zone for sellers who need buyers to execute their positions. Finally, we drill down to the 15-minute chart to identify an exact entry opportunity. On the 15-minute chart, after mitigating the 4-hour order block, we spot a supply and demand flip pattern. First, the market broke structure with inefficiency, leaving behind an extreme demand zone. But after testing this demand, the market failed to make a new higher high, signaling a loss of momentum. Second, the market breaks this demand zone to the downside with momentum, which signals a potential trend change. The candle that created this inefficiency becomes our order block supply zone. Here's how we execute the trade. Place a sell order just a spread below the order block zone. Protect the trade with a stop loss just above the swing high. Target the next structural level as our take profit zone. Also, we actively manage the trade by tracking profits. Every time the market forms a new order block, we adjust our stop loss to lock in gains and reduce risk. Well, guys, I hope you found this video helpful. If you're feeling generous, please hit the thumbs up and subscribe to our YouTube channel. We regularly publish advanced trading concepts just like this one. See you in the next video.